Welcome to today's webinar. We're so glad you've joined us today. At the bottom of your screen are multiple application widgets you can use. All of them are resizable and movable, so feel free to move them around to get the most out of your desktop space. To the right of the slide area is our resource list. In that list, you can download a copy of today's slide deck and check out other resources we've made available to you. We encourage you to ask questions throughout today's webcast using the Q&A widget. We'll do our best to answer those throughout the live broadcast and at the end. If we do not get to your question, or if a fuller answer is needed, we'll be following up with you later individually. Please note we do capture all questions. We're offering CPE and CTP credit for live attendance today. In order to be eligible, you must listen to the entire broadcast and answer the required amount of poll questions. We'll be sharing the poll results with you, so we encourage you to answer those as we go along to make a fuller experience of the webinar. If you qualify for the certificates, you'll find them in the widget and can download those before the webinar concludes. Connect with us on LinkedIn by clicking the icon at the bottom of the screen and following us. Check out our expert conversations on our YouTube page, where you can subscribe to watch future conversations. Answers to common technical issues are found in the Help widget. An on-demand version of today's webcast will be available tomorrow and can be accessed using the same link you used to join today. Under the Dodd-Frank Act, we're required to caution you that swaps have risks. At this time, I'd like to introduce today's speakers. Jackie Bowie is a managing partner and head of EMEA, providing guidance and strategy for the European and APAC regions. She is a member of Chatham's board of directors and our senior leadership team, and brings over 25 years of financial markets expertise to advise clients in the real estate and private equity industries. Mark Weiss is a managing partner, board member, and head of real estate for Chatham. He brings over 30 years of commercial real estate experience, working in senior roles in investment management, specialty finance, and mortgage originations and securitizations. We're so glad you joined us today. We hope you enjoy the webinar.
Well, good morning, good afternoon, everyone. Thank you very much for joining myself and Mark. Delighted to have you all here. Very quick introduction to Chatham as a firm, for those of you who might not know who we are. So Chatham are a global capital markets advisor, the leader in all things financial risk and hedging. Our statistics speak for themselves, so I'm not going to read them out, but just some highlights emphasizing the global scale of our firm. And we're hoping to bring some of that global expertise to some of our discussion and insights today. So with that, just a very quick introduction to the agenda. There is so much to cover, particularly even things that have just happened in the last 24 hours. But we'll try and zoom out a little, really covering the bigger kind of macroeconomic picture, an overview of the interest rate markets, focusing on the US, Europe, and the UK. We're going to drill down a little into what's happening with hedging costs. So cost of debt, major question over the last few years. A little bit about market trends and transaction activity, and then we'll wrap up with questions. Please do post your questions throughout. I know you've had the instruction on that. We'll do our best to answer them as we go, and we'll follow up after the webinar for those we don't quite get to. So let's jump straight in as we look at just the broad macroeconomic picture. So Mark is going to kick us off with what's happening in the US. Again, these numbers are changing literally. As we put these slides together, we then had to change them again. Huge amount of uncertainty in the market. And I suppose my kind of opening question to kick Mark off is the US headed for recession?
Well, Jackie, as your countrymen would say, Winston Churchill, a day is a long time in politics. And as we've seen, a month is a long time in GDP forecast. And to think about all the changes that have gone on in the last 2 months. You think about what impacts GDP in the United States and some of the big drivers right now. Things like tariffs, which is everybody's concerned about, government spending, which is clearly on the decline, deportations, which could hurt the ability of workers to spend money and pay taxes, and on the positive side, you throw in deregulation. And all that will flow through to the consumer, who is 70%, of spend of GDP. And so how does that all play out? Flip that with what's going on in the EU, where, for example, and you'll talk about this more in a minute, the German debt brake was amended on Tuesday, and they passed a 500 euro infrastructure spend, as well as an increase in defense spending. And so the question is, are we seeing a flip-flop from US exceptionalism to possibly EU exceptionalism? And there's obviously the forecasts have come down pretty significantly, which is not quite reflected here. But even the Fed yesterday brought down their expectations on where GDP could go. So I think there is some serious concern. The yellow lights from the economists now are flashing recession. We're not above 50%, but we're significantly higher than where we were 2 months ago. And what are you seeing now on the EU and the UK side?
Yeah, so I don't think it's quite a case of we're now looking to the EU and the UK to deliver outstanding growth. And everything is so much is driven by what is happening in the US. And the phrase that we are hearing all the time from our clients and the people that we speak to is this kind of heightened policy uncertainty, and how that is then going to be reflected in these GDP numbers. As Mark says, the chart doesn't really quite demonstrate what we think is going to happen in the next couple of years, other than those growth forecasts. And here we have them as the OECD numbers, which just changed as well a few days ago. So it's where those growth numbers are likely to go. But just before we dive a bit more into what's happening in Europe, just we've got, because we've had some questions come in already, I'm not asking the question about US recession, but some of those flash indicators that you mentioned, I think there was the Michigan Sentiment Survey, which was exceptionally weak, that inflation expectation coming back through. So question is really, are we too focused on some of those short-term data points, and should we be a bit more positive and looking more long-term? Because ultimately, even though the growth numbers are down, let's say 1.7% for the US GDP growth, I mean, it's not bad. So are we getting too tied up in the short-term data is my question.
Yeah, I mean, if we weren't going to do 2% in the US and we do 1.7, which, I think people are more trending, that's still pretty good growth.
Mm-hmm.
And so, yes, everybody sort of takes a, hysterical reaction to certain things, but overall the economy is still, and we'll talk about jobs
Mm-hmm.
and we'll talk about, how that's performed well. And so people have to remember that, yes, there are things that could affect it, but we have to wait and watch it and play out. Much like the Fed, who always says, they're data dependent. I think we have to be a little data dependent and see how the market plays out over time.
Mm-hmm. And I think just to add to that, I think one of the concerns, I certainly heard this just this morning, that while some of those short-term data indicators might just be a reflection of this policy uncertainty, could it become self-fulfilling? Because that eventually feeds through into the real economy.
Yeah, and Jackie, and you talk about tariffs, and we've already gotten multiple questions on
Yes.
tariffs. Will that slow down the economy? Listen, when we talk to corporations, they're telling us they're sort of in this midpoint where they don't know if they can make capital expenditures right now because they don't know what policy is going to happen and
Mhm.
how that's going to affect their business. And so the answer is, could tariffs slow down the economy? I think absolutely, particularly because input prices are going to go up, which is going to make it more difficult for the consumer to afford. You're seeing a wealth effect with the stock market dropping recently, which is again going to affect the consumer. And so all these things factor in, and a lot of that comes from the tariffs and the implications of that.
Yeah. So you asked me specifically the question on Europe, will this be the time when Europe can shine? And just going back to the point you're making about the German fiscal change, I mean, it's been described by someone else as the kind of fiscal bazooka, and the market certainly liked it. And you started to see the GDP growth numbers start to improve for the EU. There were three main pillars to that, and without getting into the weeds of it, but it's important, I think, to understand those three separate pillars because they have quite different implications for the economy. So one is, of course, the defense spending. So anything above 1% of GDP in Germany is now exempt from those fiscal rules. The second thing is the one that you mentioned, Mark, about a deficit-financed infrastructure fund of 500 billion euros. Again, a big number, looks really exciting, but those disbursements will be over a 10-year period.
Mm.
So it's very stretched out. And then the third pillar is that federal states will be allowed to run small deficits rather than having to balance their budgets. So again, it is not huge and it is not immediate impact. Now, the focus from that infrastructure fund, from what we read and hear, is that it will be on kind of shovel-ready projects, so things that are almost ready to go. But looking at that defence number in particular, what you've got to do is take both of those things together, the infra fund and that defence spending, and say, what is the fiscal multiplier? How does that then translate directly into the economy? And again, I've reviewed lots of different economists' forecasts on this, and the number looks to only meet, the question is bang for your buck, right? It looks to be about 0.4. So if you think for every euro spent, you get kind of 0.4 multiplying through the economy. Now, that's specifically for the German economy. If you then expand that out to the whole EU economy, Germany is about a third of Eurozone GDP. It isn't massive. And I expect we won't see any real impact of it until 2026. So we've gone a bit deeper on that just because it was such a big topic. Flipping very quickly to the UK. So big date to put in your calendar, the 26th of March was when the UK government will announce their spending review. And I think anyone in the UK certainly is very focused on what the Chancellor might have to do, because she has no room at all, to given her own fiscal rules. So there are some questions around further tax increases or further spending cuts, or a combination of both. And remember, the UK has also committed to an increase in defence spending. We think about the trends across all of Europe as they realise they can no longer rely on the US for that military support. So many things happening around that spending decisions in the midst of all of this policy uncertainty around the tariffs that we've talked about. So I suspect these GDP growth numbers, if we were to come back here in a quarter's time, I suspect they will all look quite different. And I suspect they will all look weaker than where they are currently.
I agree.
So shifting on to the next big variable being inflation. And certainly last year there was a lot of celebration that the inflation genie was well and truly back in the bottle. And coming into 2025, I think some people have been a little bit surprised at really talk of inflation coming back. And I have to say, I had a little shiver of fear when Powell used the word transitory for inflation in his statement. You think, yeah, we've heard that before when we came into the last inflation increase. But I think the questions that are coming in around tariffs and the impact on inflation is really where you want to focus, Mark. But I did think also this morning I had my 3-egg omelette that, the egg price in the US up 54% in the last inflation number. But what do you think people are forecasting for inflation? And is that inflation expectation that we're starting to see build up likely to change what these forecasts look like for the US?
Well, it's interesting. You mentioned the University of Michigan Sentiment Index. And in the index, it had a 4.9% expectation going forward, which is a dramatic increase from the consumer. And obviously, if the consumer starts pulling back, as I mentioned before, that's going to have a big impact on the economy. You saw this big run up because of supply chain. Then you had excess liquidity thrown into the market by the government, and that pushed inflation up. And then interest rates rose, and we got it down. And to your point, people were thinking that Jerome Powell was going to, so quote unquote, stick the landing on the soft bottom of the recession. But today, it's very, very concerning because it's incredibly sticky, and tariffs are an enormous problem because by definition, it's just increasing costs. It's increasing input costs, which ultimately are going to get passed along to the consumer. And so by definition, people are looking at that now and expecting that inflation will tick up again.
Mm-hmm.
And one of the problems for the Fed is, previously when the Fed has excess demand, they raise interest rates. And by doing that, they suck out demand and, inflation can come down. The problem you have now is, does the Fed have a good tool? Input prices are going up. By raising interest rates, is that going to help them? By lowering interest rate, is that going to help that? That's a problem.
Mm-hmm.
They really don't have the tools to deal with input as opposed to excess demand.
Mm-hmm. Yeah, and I think the certainly coming across to the Eurozone and the UK, that whole inflation fear is very real in the UK. I mean, if you think the Bank of England's still looking at an inflation forecast, and again, I think it's likely to change again, but let's say 3% at the end of this year against a target of 2, it's quite difficult to imagine a scenario of the central bank cutting interest rates when CPI is at 3%. So, and we're going to come on to the interest rate market in just a second. But the question of tariffs is coming up in all of the questions coming in. And I think it is very difficult to say exactly how it's going to feed through into inflation, because one of the other impacts, of course, is the currency move. We're going to talk a little bit about what's happening with the dollar against euro and sterling in a few slides' time. But whether a strong dollar, should we have a strong dollar, could mitigate some of those price changes. I was interested to see that some of the, particularly from a UK perspective, where some of the tariffs might specifically impact. And I think I just want to emphasize for maybe people outside the UK actually has a trade deficit with the US. And a large part of what we export is services. So whilst we're not completely immune, we're slightly less impacted compared to the Eurozone, which will be much more heavily impacted. But if Trump does add the 200% tariff onto European wines, I think you can say goodbye, Mark, to your Rioja and your Barolo.
It's going to be, I'll be drinking domestic Pinot Noir going forward.
Or you could drink English sparkling wine, not impacted by the tariffs. But, you know, in all seriousness, these numbers are huge. And you're starting to see, certainly from the businesses that we advise, those businesses starting to really think about replanning on the expectation that these inflation numbers will be higher, partly from tariffs, but also partly from some domestic influence. But when we look at what central banks have in their toolkit, you're emphasizing, Mark, that you feel the Fed is kind of maybe struggling a little bit to think about how they will use monetary policy. But the thing that I always find interesting as a non-US person is, you know, the Fed does have this dual mandate of price stability and the labor market, whereas the ECB and the Bank of England very much focused on price stability. We've seen some signs, I think quite mixed signs about changes in the labour markets, but maybe you could talk to this slide about what you think is happening there.
Yeah, and if you take a look, you know, the U.S. has been incredibly resilient in terms of the labor market. It's in and around 4%, which is very strong historically. And yes, while you've seen job openings and non-farm payrolls drop since sort of the sugar high post-COVID, they're still very strong numbers. If you're creating 100 to 150,000 jobs a month, you know, that feels very good. You know, some of the things I worry about though, Jackie, are things like Doge, and everybody talks about Doge, but what does it mean? You know, there's roughly 3 million federal workers. Okay, so that could have a small impact. But what really is interesting is there's 19 million state and local workers. And when you combine the federal and the state and local, it's 13% of employment in the United States. And now you've seen some of the red state governors, Ron DeSantis being a good example, basically saying, how can I apply Doge to state and local? And so when you have 13 million people, or I'm sorry, 18 million people involved in that, that could be an enormous number. So that makes me concerned. The other thing that makes me concerned is what we talked about before, which if businesses start slowing down their capital spending because of uncertainty, that's less hiring, and it actually could be a decrease in hiring, in firings. So that's a concern. And you know what's really going to get tricky is for the Fed. They're going to be in a difficult position if inflation stays sticky and the unemployment rate starts ticking up. Because to your point, they have the dual mandate. And what do? If they start lowering rates because unemployment rises, but then inflation picks up, you know, then they're going to be tagged as the guys who, you know, let inflation go up again, much like they did last time with your comment about transitory. So that I can, you know, talk about Fed tools, they're going to be in a sticky position if that happens.
Yeah. We've had a few questions come in specifically about treasuries and bond yields. So that's a perfect lead in. So people are asking us the question, but we are actually going to ask the audience the question first. So that leads us really nicely into our first poll question. So I'll read it out. Again, you have to choose one, and then we'll see if Mark Mark's prediction is the same as the audience. What will happen to the yield on the 10-year Treasury from today to the end of 2025? Decrease by 50 bips or more, decrease by 25 bips, stay the same, increase by 25 bips, or increase by 50 basis points or more. So we'll leave that up just for a minute or so, give people a chance to respond. So we ask this question in our market updates for the last two that we've done, and we find that people who join the chat and webinars are very smart and usually get it pretty close. So, Mark, what did our audience say the last time?
Yeah, and what's interesting is there's a situation where they didn't get it close. And I'm going to go back to 2 webinars ago.
Okay.
So in March 6th of 2024, the 10-year Treasury was at 4.11. 76% of the respondents said it would stay flat or drop 25 to 50 basis points. 5% said it would increase 50 basis points or more. It actually increased 47 basis points from 4.11 to 4.58, and that was to the end of 2024.
Okay.
So people were not as accurate as we had hoped. In September, your last webinar, the 10-year Treasury was at 3.79, and we were predicting what would happen by the end of 2025. 88% said down or flat. And, as of this morning, it was at 4.21, which is a 42 basis point increase, as opposed to 88% who said decrease. Now, we do have till the end of 25, but it's an indication. And I think part of our emotions get involved here, where everybody wants interest rates to come down.
Where we want it to be. So let's see what the outcome is. Okay, so the 43%, 44% think decrease by 25 basis points. Gosh, this is quite spread, actually, so same conclusion. We're in such an uncertain environment. And I think this is reflected here on what people are saying. Mark was asking me to write my little number down on the piece of paper, which I refused to do. But if I were to lean in any direction, I would certainly lean more towards the increase by the end of the year, but probably in the 25 basis point category. How about you?
And I think I'd be flat.
Okay.
So you and I are relatively aligned.
Okay. So that's looking at the Treasury market specifically in the US, such a big barometer for sentiment, as well as kind of funding costs in the market. But here at Chatham, obviously, we spend every minute of every day thinking about what's happening in the forward curve. So Mark will kick off on the US, and then I'll pick up for the Europe and the UK.
Yeah, I'd like to call this slide what's old is new again. And you'll see that when we look at the forward curve 1 year ago and today. But if you take a look, so 1 year ago, there was an expectation, there was 6 to 7 cuts. We've gotten 3, which is actually 4 cuts, because one was a 50 basis point cut. And then what happened? 9 months ago, there was a pickup in inflation. There was a strong labor print, and the curve shifted up 50 basis points. And that's that light blue line up above. And then in a 3-month period of time, look down to the bottom to the gray line. There was a bad labor print. Inflation, took down a hit. And more importantly, the Fed gave a surprise 50 basis point cut. And what happened, that's a 100 basis point drop from 9 months ago to 6 months ago. So you could really see the volatility. But what's happened now in the last 6 months? Inflation has gotten sticky again, and the labor market has remained solid. And so you've had all this volatility, but you're basically back to where you were, 1 to 2 years ago. And what's interesting, Jackie, when you think about what came out of the meeting yesterday, the dot plot was very interesting. You went from one person having a 0% cut for the remainder of 25 to 4, and you had another 4 who only had 1 cut. 9 at 2 and 3 at 2 at 3 cuts. They said, so that really actually works out to around 1.5%. So it's really gotten much more hawkish. And the Fed effectively called out the federal government by basically saying the uncertainty created by what's going on in the environment, tariffs and other things, has caused them to be, I think, a bit more conservative about how many cuts that they were going to have.
Yeah, and I did see Trump's response to that with that the Fed could help ease the transition with the
Yes.
tariffs. So I don't know if that's an official response when it's on X or
Yeah,
not.
and the one other thing I'd mention, Jackie, is what people don't talk about was the QT,
Mm-hmm.
quantitative tightening, where the Fed was buying $25 billion a month, and they've lowered that to five.
Mm-hmm.
And so that 20 billion effectively creates more liquidity, in the marketplace because the Fed isn't dumping,
Mm-hmm.
all these securities onto the market. In some ways, that's an implicit minor rate cut because there's more liquidity,
Yeah,
but it's really more about pushing liquidity into the marketplace.
yeah. And I guess those movements in the forward curve that you've just emphasized, that's then obviously reflected completely in the 5-year swap rate, which, again, the kind of barometer for borrowing costs. And the conversations that we're having with clients is as they try and understand, well, what rate should I assuming for financings, refinancings, and that forward curve is what feeds into their financial models. So these charts show, where the 5-year kind of SOFR swap rate has gone, reflection of that
Yes.
movement in the forward curve. One of the questions we usually get around these slides is around the Hairy chart. Please go to Chatham Rates. You'll see the Hairy chart there. For those of you who don't know what that is, it's basically showing what the forward curve was predicting versus the actual outturn. And the conclusion is the forward curve will always be wrong. It's just a question of by how much. So I'll quickly just do the same analysis for the Euribor and the UK market. And it's a very similar theme, albeit slightly different in terms of magnitude and the timings of when those shifts happened. But I think the one thing to highlight is, where we were a year ago. So that's that kind of like dark, my colors aren't so great on this chart, but the kind of dark blue versus where we are today, which is that light blue. And moving on to then, what does that tell us for the cost of funding in the European market? Again, looking at that 5-year Euribor swap rate is a really good barometer as to what that cost is. And if we look at where we were kind of November 2024, and then we had this increase through the end of the year. And you think that's still within the context of assuming that we were in a falling rate environment. And I think that's the same theme that's in the US, right? You're in an overall falling rate environment, but at the same time, the actual cost of debt in the market is going up and down quite materially as that forward curve is moving around. Again, just shifting very quickly to the UK. I'm just going to call out where the forward curve is today. So if you look at that kind of green line, and the thing I would really highlight is obviously still expectations of rate cuts. The Bank of England, I'm sure you've already seen the headlines from today, so on hold. And with, again, some quite interesting commentary that has made some people question whether we will get any rate cuts this year. And I did see one economist still out with a prediction of UK rates at kind of 3.5%. With those inflation numbers we just talked about, that it seems that would be unlikely. Again, going back to that point that the Bank of England have that single price stability mandate. But the one thing to call out specifically on UK rates is even if we get those, let's say, another 25 basis point cuts this year, rates are actually expected to then pick back up again in fairly short order. So this we're in a new cycle of interest rates, and the question is, will it be the kind of a very short cutting cycle before we see rates coming back up? Same story as we look at the funding costs. And again, we have so many conversations with clients about, well, why would I think about fixing my cost of funds today? Why would I think about hedging today when rates are falling? And I always say, in my dating myself too much, but having done this for many decades, deciding how to hedge or deciding on your optimal cost of funds when rates are rising is challenging, but it's actually a slightly easier decision because rates are rising and you're trying to optimize. I feel when you're in a falling rate environment, it's actually a much harder decision because the natural inclination might be to just wait and see.
Mm.
And what we've highlighted through all three of those forward curve movements is the curve is pricing so much in advance. And if the curve is wrong, the Hairy chart tells us it will be wrong, then you should be making your hedging decisions and funding cost decisions off that forward curve rather than trying to call what the central bank is going to do at their next meeting. So there's so many questions coming in. I'm trying to just run through them very quickly. I'm going to just stick with the kind of cost of hedging for now. And it's difficult to do this and cover all three markets and give them all their kind of due airtime. So there are other slides in the appendix, and please reach out if you want to dive into this a little bit more. But in advance of putting the webinar together, we were getting so many questions in from our clients, so we felt it was important to highlight this. So what this chart shows is, again, is a little bit congested, but showing sterling, euro, and dollar, the cost of an interest rate cap over time. It's important to highlight on the left-hand side, the strike rates of the caps are different. So that's a reflection, of course, of the underlying curve in each market. So they're not like for like pricing, just to highlight that. But really showing how much the cost of buying protection, i.e. an interest rate cap, has obviously come down from its highs, but actually is still pretty volatile in the last few months. On the right-hand side, what we've shown here is the cost of an interest rate floor. Now, again, some people might say, why do I care about that? Well, a couple of reasons. One, interest rate floors are still present within loan facility documentation, when certain lenders will have a minimum rate in there. Secondly, the cost of the floor can help you understand how much the market is pricing that expectation of rates falling, the value that's in that floor. So again, we've shown here across all three currencies and markets the trends in that floor pricing.
And Jackie, one of the things interesting with real estate clients is certainly in the last couple of years, we've seen a lot of 1-year caps, which historically we had 2 and 3-year caps. And that was primarily for two reasons. One, as you can see on the chart, the expense was so significant that people's hopes were that the cost would come down, and they have. And so they're just rolling 1-year caps. And the other is, and we'll talk about this a little later, is transaction volume. And transaction volume, people didn't want to transact where the cap rates were and the capitalization rates were in the market. And so therefore, they want to just continue to roll 1 year with the expectation and hope that interest rates would come down, therefore capitalization rates would come down, and they'd be able to hit the market to dispose of assets that they wanted to.
Yeah. There's quite a few questions coming in just around the kind of creation of the forward curve, a little bit more about the Hairy chart. We won't have time to dive into those answers today, but we'll definitely follow up. We have some great resources on explaining how the forward curve is created and what the Hairy chart is telling us. I'm just going to bring those two concepts together. So the cost of an interest rate cap and the cost of an interest rate floor. And again, the reason we showed this is just based on conversations with clients and banks as they're looking at different structures to hedge interest rate risk. So this one's a little bit more complex, but very briefly, again, when interest rates are falling, some borrowers are coming to us to say, is there any way I can hedge my risk without using a swap, but without paying upfront for an interest rate cap? And the structure that lends to answer those questions is an interest rate collar, where basically you're buying an interest rate cap at a strike rate, and you're paying for the premium on that cap by selling an interest rate floor. So what that means is that you're giving away any benefit of interest rates below the floor, but you're getting that protection at the upper strike rate, and hence it's called a costless collar. And it sounds like the perfect solution. You say, well, great, because I get my protection, but I don't need to pay for it. And what this chart is really trying to demonstrate is that there are many market environments where an interest rate collar, especially one that is zero cost, just does not make economic sense. So each of the vertical lines are the cap rate. And then what we've done is to say, okay, where would the floor need to be over these different time periods to make the structure zero cost? So for those of you that are interested, I would encourage you to spend a bit more time on this slide after the webinar. By all means, get in touch and we can talk through in a little bit more detail. But using an interest rate collar as a hedging strategy, I hadn't seen them in all of the years when rates were very low, but certainly the number of questions coming in on these is certainly increasing. So we're going to flip to the next poll question, really to take it back to you. And again, based on the questions that are coming in, I'm super interested in the answer to
Yes.
this one, Mark.
Yes. So the next question is, what policy is most likely to impact the global business environment in 2025? A, government spending, fiscal policy. B, monetary policy. C, deregulation. And D, tariffs. And Jackie, you were telling me something about a Google search of a particular word on this page. Maybe you could talk about that.
Yeah, I think if you were, and we have to emphasize you can only choose one.
Yes.
So it's the most likely. Yeah, I think that someone had done some analysis around if you were to measure which policy is going to have the biggest impact on the business environment, economic environment, based on proportion of print coverage, well, digital print coverage, then you're going to say tariffs like for forever. And it was quite interesting the way they had represented it. But I mean, I suppose tariffs also may eventually feed into some of these other aspects. So if I'm going with that Google search proportionate coverage on media, then I would certainly go for tariffs. How about you?
I think I would probably go for tariffs as well. I think all of these will have an impact. But when you look at, the government spending is clearly coming down. We've talked monetary policy is just a little uncertain right now. Deregulation will help the economy, but tariffs are the great unknown. And as I said, even the Fed called it out in their statement yesterday.
Yeah.
So I'll be curious to see if the print media, and sure enough, it wins with 69%
Yeah.
of you say tariffs, with government spending and the fiscal policy at 19%, with the other two lagging very far behind. And I guess this is one of those polls, Jackie, where we're not surprised by the answer.
No, and again, from what we've talked about today, of course, is the uncertainty on the impacts of these tariffs. I know I've mentioned the UK position feels slightly insulated, but the aluminium and steel tariffs have already come into place. Unfortunately, the UK's ONS, which is our National Statistical Agency, made an error in our trade data. So everyone was waiting to see if there was any impact. And then they said they couldn't report it because they couldn't count it properly. So that number is now delayed. But it's the 2nd of April, right, is your Liberation Day, I think.
Liberation Day, is that what we're calling it? Yes. And Jackie, if, you were talking about the print media of saying tariff. I think we've mentioned it just a few times on this webinar as well.
Yes, it's well covered. So flipping back to just some trends in the markets, we've talked about what's happening in those forward curves. We've talked a little bit about central banks and monetary policy. But one of the other repercussions of what is a pretty large interest rate differential has been the movement in the currencies. So on the left-hand side, we have the spot exchange rate with GBP USD, traditionally known as cable, and Euro USD. And whilst in the European and UK media, they've very much been reporting the story of euro strength and sterling strength, I think in reality, it's actually a story of dollar weakness. And that it certainly looks likely to continue, certainly over the next few months. And part of that also related to what we were talking about the changes in those GDP numbers.
Yes.
With the US, kind of reduced forecasts for growth, and Europe ticking up just a little. But bringing it to the kind of reality of day-to-day decisions, Again, we try and put these themes together based on the most common topics that we're speaking to our clients about. And one of the major questions is, if I have the ability to borrow in euros, then I can take advantage
Hmm.
of this interest rate differential. So on the right-hand side, what that shows is the per annum savings of borrowing in euros versus dollar, and that's just derived from the 5-year cross-currency swap. And again, it's really interesting conversations, particularly if you are an international borrower, an international business, so you have a natural euro exposure anyway, then absolutely it's a no-brainer to be taking advantage of just how big that interest rate differential is and could potentially get wider if the Fed don't cut this year at all, which there are some scenarios where they don't, and Europe continues to cut interest rates, and again, this is Europe, not the UK, then you could see that interest rate differential widening further and that real opportunity to reduce funding costs.
Yeah, and there's a very real possibility of that
Of
occurring.
no cuts. So whilst we focus really on UK, Europe, and the US, just while we're on the exchange rate question, we wanted to just throw in another currency, really just because the trends have been very interesting. So I'm going to pass over to Mark to get his views on what's happening with JPY.
Yeah, and this is a 4-year chart of the USD JPY exchange rate. And you can see what happened. Why did it go from basically 100 to 160, over the course of sort of 3.5 years? And I think a couple of things happened. One, you had rates go up dramatically in the United States. And at the same time, the Bank of Japan was keeping rates at historic lows. And so that really had a significant impact. And you've seen sort of a shift down from, call it, 160 to 150. And what's happened? I'd say two things. One, you've had the Bank of Japan, finally starting to raise rates, which has, been a long time coming. And the second thing is, and this is an interesting one, Jackie, which is, are people looking at Japan and basically saying, maybe they're a safe haven, maybe there's stability in the storm with Japan. And because of the uncertainty of the US, the trade with China, with Europe, with UK, but you don't hear a lot about Japan. And Japan is just sort of that stable, just plodding along economy. And I think people sort of view that as somewhat of a safe haven.
Yeah, and I've heard the same. I mean, outside of the markets we focus on, I've certainly heard that from some of the global asset managers as they are looking for, they've got to put capital somewhere. And whilst everyone seems to have gone very long US treasuries, for those that have to make allocations to equity markets, it certainly seems that Japan is considered a kind of safe
Yes.
haven from that perspective.
Yeah, and then turning to the next slide, I like to use real world examples to sort of really break it down into its most simplistic level. And this was a real estate transaction. And you could take a look. So in January of 21, you had a property had an NOI of 100 yen, and you bought it for a 10% capitalization rate. What does that mean? You bought it for 1,000 yen. At the time, the yen was 103 to the dollar. And so in US dollar terms, you paid $9.71 for that asset. Now, fast forward 4 years, your NOI has gone up to 130. Congratulations to your asset manager. You've done a great job managing the asset. You brought up the NOI 30% in 4 years. And let's say, okay, capitalization rates haven't changed, still a 10% capitalization rate. So you sell for 1,300, again, a 30% increase. But what's happened in that time? The exchange rate went from 103 to 157. And so when you translate that back into US dollars, that's $8.28, or a 15% hit to the purchase price that you paid, yet your NOI was up 30%. Now, this is very simplistic. It doesn't carry costs or liquidity and other things, but it makes the point that Japan was always considered a very stable currency against the US dollar. We've been talking to a bunch of our clients who've had funds who didn't hedge, and while they outperformed in their portfolio, they got hurt, ultimately when they had to translate back. And so we're having a lot of conversations with clients now who are looking not just to Japan, but to other places because of the volatility of currencies, where they want to sort of take that out of the equation and just focus on what they do, which is building their business.
Yeah, and I think that's specifically why Mark, it's a great case study to demonstrate. You could apply it to other currencies, but I think the bigger question, I think, which is arising to your point, is returns are harder to come by. Debt is more expensive, and people are more switched on to the other risks in the returns that they're generating in whatever asset class they're in.
Hmm.
So I think the question about hedging currency in cross-border transactions is arising much more frequently. It doesn't always lead to an execution of a derivative. So that's the next decision
Yes,
along to what you've described here. But I think certainly the inbound questions and our clients saying, what are other people doing on this? And I think if we go back to in the last 10 years of kind of really low interest rates, returns were good across most asset classes and people were less concerned. Now there's a real laser focus on pinning down everything that could potentially erode those returns.
exactly.
So let's move on. So again, just trying to do a quick kind of summary at the 45-minute mark. Uncertainty around the bigger macro trends, which are completely driven by this heightened policy uncertainty. Taking that through into what's happening in interest rates, again, there is not a clear pathway for 2025, certainly for the Fed in the UK, in terms of how many rate cuts we might see. That's leading to opportunities to be able to borrow in different currencies. And certainly the heightened policy uncertainty is translating into heightened focus on risk management. But what does that really mean for what we are seeing in terms of transaction volumes and general activity? So Mark's the real estate expert, so I'll ask him to comment on this.
Yeah, and this is one of those where I wish we had better news.
Mhm.
When you look at 2023, there was a phrase that was used, which was "stay alive till 25," and it reminds me of another quote from a famous U.S. football coach, Vince Lombardi, who said, "Hope is not a strategy." And I think for a lot of real estate folks, hope maybe not a bit of strategy, but it was a hope that interest rates were going to come down, and to stay alive to 25 was the expectations that the markets would be roaring again because interest rates would sort of revert back to where they were. And that obviously hasn't happened. And so you see the volumes in 23, 24 very muted versus history. And going into 25, we've seen the exact same thing where real estate volumes in the US have been very muted and the mood is not optimistic. Flipping to the EU, Jackie and I were just at a conference last week known as MIPIM, where sort of 40,000 European real estate folks get together. And I would say it was the same mood that we're seeing in the US, which is a little pessimistic as to what we're going to see in terms of transaction volumes
Mhm.
in 25.
Yeah, and I think taking the kind of trend of 24, there certainly was real hesitancy. Q1, I'd say that was the summary. Elevated interest rates, still inflationary pressures, a little bit of stabilization through the middle of the year, and then a decent amount of activity in Q4. So even though these numbers show annual, if you to break it down quarter on quarter, it was quite a different vibe in each of those quarters. And there certainly was some hope that the increased
Yes.
transaction activity in Q4 would have carried on into Q1 this year. And again, repeating the same phrase, this heightened policy uncertainty, I think, has put a real dampener on that. And yeah, out at MIPIM, other than it was raining so badly, that certainly impacted the mood. There was a real, people wanted to be optimistic. But I actually saw quite a divergence between you speak to lenders and loan originators. They were kind of verbally a bit more optimistic about the market. They were citing, valuations have reset, kind of healthier borrower credit. But then when you talk to the actual asset managers themselves, certainly less optimism there. And this wasn't just European. There's lots of US investors and lenders that go to MIPIM for this week in March. So certainly feels like there's still that hesitancy is back in 2025. And I think that that muddiness of the outlook on the interest rate market is also impacting
Yeah, and
team.
I think your comment about lenders is one of the reasons you saw spreads come in on loans rather dramatically at the end of last year,
Yeah.
where there's more money available, from insurance companies, from CMBS, from banks, from regional banks, and non-bank lenders, which we'll talk about. And because there's so much money chasing so little product because there weren't that many acquisitions, the spreads came in pretty significantly. And I think that I don't see any reason for those to go out too much because, to your point, values have been reset. And
Mhm.
so now I get to lend 65% on an asset that's now worth 80 million, which 3 years ago was at 100 million. And
Mhm.
so you just feel better about your position in the capital stack.
Yeah. Yeah. So another year of wait and see for things to work through. So of course the other market activity that we pay a lot of attention to is really what's happening in the global M&A market. This drives a lot of activity for us here at Chatham as we're helping within those M&A transactions. If there's debt structuring, capital market advisory, of course, hedging work to be done. So we're very much in the mix of this. And the theme was very similar in that 2024 was better than 23, but still pretty muted. I think a lot of the private equity sponsors were kind of looking to try and make exits to then redeploy new capital in funds that they had raised. I think the one of the kind of macro trends, and we touched on this a little in one of the poll questions, is around the kind of regulatory environment. And I was hearing this yesterday in two different conversations with clients where the whether it's enhanced, antitrust, some of the kind of foreign investment regimes that they have to operate in, but just adding complexity to deal execution. That was the summary. So from our perspective, when we're looking at it from capital markets hedging, taking risk out, we can help with all of those. But that whole antitrust and regulatory part seemed to be a barrier. So to your point, Mark, about that increased regulation being good, or excuse me, decreased regulation being good, in fact, it could also open up some deal activity, right?
Yeah, and I think you saw that with the Google announced acquisition, which sort of got put on hold last year because of the regulatory framework, with the expectation that it will sail through with the new administration.
Yeah.
And I would say the other thing on the M&A side that we're clearly seeing is people still believe in size and scope. And so while you're not sort of seeing Merger Monday, where every Monday you read about another 30, 50, $100 billion merger transaction, there are a lot of twos, threes, and fives as people focus on their business
Mm-hmm.
and need to grow size and scope. So, and I think that's helping that the activity level on the merger side as opposed to the bigger transactions.
Yeah. And you mentioned, Mark, just about those spreads coming in terms of the cost of debt. And I think one of the other kind of trends of liquidity and capital sources has been the increase in non-bank lending. So we're going to go back to the audience just for another poll question so we can dig a little bit deeper into that.
Yeah, and so the question is, do you expect to include an element of non-bank lending in your capital stack in 2025? A, yes, already using. B, yes, we expect to start using. Or C, no. And Jackie, we talk about the amount of money that's been raised over the last few years. It's if you thought about today, the Google search is tariff, tariffs, tariffs. It was sort of private credit, private credit, private credit. And so you're really seeing them make an impact in so many different ways. And, really starting out at sort of the higher leverage points and the mezzanine points, and now really moving into the senior loan positions where they're competing with the commercial banks,
Yeah.
which they hadn't previously.
Yeah, and also seeing there's seen a couple of announcements even this week of the insurers getting together with some of the private credit asset
Yes.
managers. And I'm always interested because you think about insurers, they would be in the public fixed income markets. So are they partnering with the private credit and thinking about that as their fixed income exposure, but with higher coupons, higher risk too, but higher coupons. So let's see what our audience are seeing in terms of trends.
So interesting, sort of split right down the middle, which is, 31% say you're already using, 18% say you're expecting to use it, and 50% saying no.
Hmm.
That's interesting. Jackie, I think I might have thought that might have been a slightly higher number on towards the yes in terms
I
of using
agree.
private credit.
Yeah, I would have expected it. And again, we have a little bit of sample bias based on the conversations we're
That is
having. So
true.
we're maybe overweighting. I would have expected more to be saying, yes, expect to start using.
Hmm.
Because I also think the private credit, private debt funds have done a really good job in getting out there with their offering, where their sweet spot is, where they want to lend. So um, I think we did have, yeah, this was the point you were making, Mark, just to kind of wrap us up on the private
Yeah,
debt side.
and this is funds raised, so institutional flow, so funds raised, and you just look at the last couple of years, and so obviously all this has not been deployed yet, and so therefore this when you look the multiplier effect of adding the last couple of years of capital raising is just an enormous pool of money that's available to be put out there.
Hmm. Okay, so we're going to bring this to a wrap with a final poll question. And it's really to try and bring everything together of what we've talked about for the last 55 minutes, which is in this era of heightened uncertainty, it's kind of the phrase of the morning, and also the challenges of looking at the interest rate markets for the cost of debt, for your hedging strategy. We've talked about the volatility in FX and also the opportunities that that might offer. So, again, really to come back to our audience and try and understand just from your perspective, given everything we've talked about and the volatility in interest rates in the last 3 years, has your risk management policy become a higher priority? Now, I think most of the people we speak to would say, of course, it's a priority. We're trying to just get a sense for is it becoming even more so given the environment we're in? So your choices are A, it just remains the same, B, it's a slightly higher priority, C, it's a significantly higher priority, or D, it is the highest priority. And again, from our perspective, we probably get a bit of sample bias in this because every person we're speaking to, it's because they're making risk management a super high priority and looking to really try and optimize, what's happening in the markets.
Yeah, and just as Jackie said, the volatility, whether it be on interest rates, whether it be on FX, all these things play in, and you want to run your business,
Mhm.
and you want to be successful at running your business, and you want to try to take out, I'll call them the exogenous factors that could, when I use the yen example of buying that property, you want to take those factors out. And
Mhm.
so I think you're right. We probably have a little bias because we talk to people all day long
Mhm.
who are actually really and highly focused on this topic.
Well, let's see. Um, Okay. So I would probably add the two middle answers together. So between it's a slightly higher priority and it's a significantly higher priority, it's kind of three quarters of the
Yes.
answer.
So maybe our bias was actually correct.
Maybe our bias was correct. So we are just bumping up against the 1 hour here. There are still some questions coming in. Some of them really deserve quite long
Mhm.
responses to really give them their credit. So we will come back to you with those responses either by a phone call or an email. So please don't think we're ignoring them. But we want to just wrap up with a few reminders. You can receive weekly chat and rates into your inbox. Please have a look at our FOMC meeting recap from last night's announcement. And we have lots of podcast expert conversations available, which are really interesting with a whole variety of topics covered in them too. So, just for us to say thank you very much for giving us an hour of your time in the midst of all of these things that are happening in the markets. It's been a pleasure to be with you this morning, Mark, and have our
Thank you to
conversation.
call you partner on this one.
Thank you
So
very
thank
much.
you. And thanks to the audience. Again, as Jackie said, an hour is not an insignificant commitment. And we appreciate you taking the time and sharing your moments with us.
Great. Thank you.